Let's talk about your latest research as well into the EV space. There's been a bit of an EV winter that starting to see, some clawing of success. At least here in Hong Kong, some of the big EV makers, the prices are up since February. But where are we in that evolution of the downturn? And you are quite bullish compared to others.
Yeah, for sure. There's definitely been an EV slowdown over the last year or so, and we actually think we're approaching probably near the trough of that slowdown. Actually, when we look at the drivers of that, there's been subsidies removed in various markets, such as in Europe, but I think one of the biggest issues has really been some of the macroeconomic headwinds. In other words, higher interest rates impacting affordability. But we're starting to see that moderate, and actually we think you're starting to see an inflection and an acceleration in growth, which I think you'll see come through as soon as some of the April figures, and certainly into next year, we think driven by regulation in Europe, but also the huge cost compression that's going on, driving prices down.
Well, you're seeing the cost parity to the internal combustion engine cars starting to level out by 2028, is that?
Yeah, I think by 2028, and some car makers will get there sooner. When we look at across the whole value chain, from the battery cell makers, mining, up to EV assembly, all throughout this value chain, there's a huge amount of work going on to drive costs down, performance improvements, and that's really going to end up in much lower prices for the consumer, basically. So I think by 2027, 2028, we should be able to make certainly medium-range cars at the same price as ICE. And at that point, EVs should sell themselves. It's not about regulation.
So this is sort of an investor conference as well, and Hong Kong looks at where the investability is in this space. But a lot of these Chinese automakers, I was just at the Beijing Auto Show, they dominated the buzz, definitely, whether it's the Xiaomi SU7, BYD taking over the top spot over Tesla. But a lot of these, most of them, are not profitable. And there's a price war domestically that's driving things down. So where does the investor who looks at this space, looks at your bullish report and says, where do I get into the game?
Yeah, look, that's the difficult part, and that's what we're here at our conference to try and find out. And look, there is excess capacity throughout this value chain, right? From certainly from the mining side right up towards the forward side and EV assembly.
How bad is it? How much is it?
Well, on the battery cell side, you've probably got 40 to 50% oversupply. On the EV assembly side, probably 30 to 40%. But that part is growing pretty fast. And we talk about overcapacity in EVs, but there's huge overcapacity in ICE as well, and there always has been in the car industry. I think it's the direction that's important, and we think EV sales are going to quadruple by the time you get to 2030. So that overcapacity should dissipate over time, and actually we think the utilization of that capacity is going to be improving over the next few years. So in terms of where to invest, of course you have to tread carefully, and there's different companies in each stage of the value chain that can be attractive. But that forward side, some of the EV assemblers, we think you'll see some of those margins start to inflect positively pretty soon.
Is it going to be driven by these Chinese makers at the expense of the legacy automakers who have not kept up either on the autonomous driving space or in the gadget-laden cars that the Chinese SU7 from Xiaomi and others have offered?
Look, I think it's undeniable the huge progress that China has made, and there's been a huge shift of gravity of the industry towards China. But I think the answer to that question depends on which region you're talking about, because certainly in the West, the brands do still count for something in the European and US markets, and of course it's not necessarily easy from a trade perspective to move cars around the world. So I think it's less about where you're from, but how you compete going forward.
So let's talk Europe, though. Then what's going to be the strategy for the Chinese makers if they're going to be faced with 20% tariffs, as is likely? Leapmotor just said, we've been planning for it. It's going to happen. The US, it's a different ballgame. Probably not going to be allowing the Chinese makers to come in. But Europe, what do the legacy car makers have to do to fend off that competition? Yeah,
look, I think firstly, whether we have tariffs or not, ultimately the Chinese will need to produce in Europe to sell in Europe in the mass market. Mass cars don't travel globally that well because of the price point. So we will see local production from the Chinese, and at which point the cost advantage narrows a little bit because of the labor rates. But in the meantime, the incumbent car makers need to use that time to drive down their fixed costs and be very lean on their labor costs, on their R&D costs, reduce complexity, and also partner with others and think about where in the value chain do they want to compete. Do you want to be super vertically integrated like BYD, or do you want to work with the best in the industry to benefit from the best costs and best technology?
Yeah, because at the auto show, the Mercedes CEO, and they've had joint ventures, they pared back their joint venture with BYD in Denza down to 10%. They also have a partnership with Geely, but he was essentially saying, we're not looking at doing more joint ventures with actual car makers, but technology partners.
Yeah.
Is that the key there? Because the big buzz at the auto show was the SU7 from Xiaomi. technology companies coming in and making a play?
I think it's looking about what is the gap in your skill set and your R&D processes as a company like Mercedes or any other Western firm, and who can help you plug that gap. So Mercedes doesn't need to learn anything probably about manufacturing its cars. It's not aiming to be a huge volume maker. So yes, it makes sense for them to team up with technology partners. For somebody else, so we're looking at Stellantis teaming up with Leapmotor, getting access to low-cost EV platform and manufacturing, then there's a different rationale. So I think it's a different strategy for different car makers.
So the big buzz last week as well was Elon Musk flying into Beijing, signing, basically getting approval for FSD, full self-driving, with its partner Baidu. Is that a game changer or a watershed moment? Who needs whom more? Obviously, Elon Musk and Tesla need China, but does China need FSD?
Yeah, look, that was clearly a positive development for Tesla, because others were starting to get ahead of them in terms of self-driving capabilities that they're offering in China. So our view on that is, I wouldn't call it a watershed moment, but I think it certainly helps Tesla catch up where the competition are. But Tesla really needs China. Obviously, it's the biggest car market in the world. They want to lead on full self-driving globally, and they weren't doing that in China. So this at least helps them close that gap to the peers, which was starting to open. But they still have a lot of work to do to really become a leader on that.
Is Tesla in trouble in China?
I wouldn't say Tesla's in trouble in China at all. They were still selling a huge amount of cars here. But they need to prove that they can catch up on the self-driving offer.